After having listened to Mr. Schmull, I think we have been given the broad picture on the macroeconomics of the situation. And now the big question is, how are we going to respond to that as microeconomic investors? Can I have silence, please? Thank you. So I repeat, the macroeconomic situation is what it is. We do not influence that. We can vote, but that has no influence whatsoever. The only thing you can do is to safeguard your capital so that your family and your future generations can depend on you, because depending on the government is never a good idea. So the question is, how do we structure our portfolio in a safe manner? Just a little adding from my side on the macroeconomics, just to have an idea about how bad it is with global debt. These are IMF data. So this is data from the mafia, so you can be very sure it's the right data. There's an average of 266% debt. Okay, I have to stay in the middle. With Japan at 395% of GDP. That's the developed countries. Then the emerging countries, with China being the biggest emerging country, has an average of 168% debt, and China 254% debt. And then the low-income countries, mostly in Africa, have an average of 77% debt, which, well, China was in the last one, with Vietnam being at 189. So that is the macroeconomics. So the conclusion, very short on macroeconomics, the figures I found in that article talked about 200 trillion in nominal terms, which is 225% on a global scale. Okay. So this debt is out there. It's a balloon that is inflated, and there are an enormous amount of triggers that could, trigger the situation. I think there have never been so much potential triggers for a bad situation. So people ask me, what will be the trigger? And my answer is, I don't know. I don't know. So the question could be, well, what do you do if you don't know? People ask, you are the investment guy, you should tell me what I have to do. Well, I say, I don't know. I think that's the most honest answer anybody can give. So what is the strategy when you don't know anything? My answer is stay liquid. So my strategy I pursue at Macrotrends is a liquidity strategy. And now the first reflex will be, well, liquidity, with banks that are heading towards disaster, with inflation coming on, how do you preserve liquidity without losing buying power and without taking too much risk? That is the enigma you have to solve, isn't it? But my philosophy is this. We see that everything is overvalued. Real estate is heavily overvalued. Stocks, heavily overvalued. Bonds, I think they are overvalued. Everything is overvalued. So if everything is overvalued in terms of money, could it not be that money is undervalued in terms of everything? That is my thought. So whoever can keep his buying power, whoever can keep his liquidity during a crisis or after a crisis, well, will be richer than the rest. You don't have to make money in relative terms. You have to preserve what you have. And if everybody around you becomes poorer, it's a bit cynical, but that's how it is, then you are richer. So it's a relative game. So how do you do that in a system where banks are in deep trouble? I think, well, I just said I don't know where it's going to start. Knowing is being sure, but my belief is that it will start in the EU. Why? Because you can talk about the Fed bailing out the whole world, but at least they have the world reserve currency. So they have the biggest army in the world, and they control NATO. So NATO is a bit like when you haven't paid your debt, how do you call that? The official from the government comes and knocks on your door to take all your furniture. Well, NATO is that, but on a global scale. if you don't pay your dollar debt, well, then you will be named a dictator and you will be ousted. And then the IMF comes in and reforms your country. So they have that. Europe does not have that. What Europe has is diversity. And diversity is a good thing in cultural terms, but it's not a good thing in political terms. Because then it becomes division. And if you have a divided political system, you cannot be as strong as the dollar. So what Draghi did was, the creation of the euro. That's a very important point. Dr. Philip Bagus has written a book that you should all read. It's called The Tragedy of Euro. And he says that if the euro would not have been created, that the southern countries, Italy, Spain, Greece, would already have defaulted like 20 years ago. But if you make a new currency, joining strong economies from the north with weaker economies from the south, on average, the credibility of the whole rises, on average. So that's why they could postpone the crisis another 20 years. But this is coming to an end. Everybody realizes that there are a euro with two speeds. And so what we get, especially in the east of Europe, are the phenomenon of the non-performing loans. And this is the biggest problem that Draghi is facing. That is deflation. Goldbug say, yeah, we are in an inflationary period. But that is static thinking. It's true, there's a lot of inflation, namely creating new money. But on the other side, there's also a lot of non-performing loans which are causing deflation. So he has to do a balancing between those two. And instead of having a crisis, which comes from Greek krinein, which means to make a distinction, that's the hour of truth, the moment you have to let it pass and then you can start again. No. Instead of letting the deflation take its run, he started re-inflating the bubble. And so we have been, in the last 10 years, we have had negative interest rates since 2014. We are in the 5th year of negative interest rates. And there is no way out. The last study is by David FOLKERTS-LANDAU, and he says that, there are 2,000 billion of deposits in the EU, and they are penalized. Deposits with the central bank, they are penalized at 0.4 negative interest rates. So that's 8 billion a year that goes to paying, it's a fine actually. The banks pay that. And on the same side, they have no income. So purely as a company, the banks are really in trouble. That's why you have to pay for everything the banker does. If he moves an inch to the left, 4 euros. I get cash out of the wall, 2 euros to get cash out of the wall. What is this? Well, very simple. If you have to cough up 8 billion a year just to pay your fines with the central bank, that's what you get, and it's going to get worse. We're going to get even lower. So purely on a macroeconomic or a microeconomic scale for the banks, that is a big problem. While in the US you have 2.4%. On less deposits, but at least the deposits, give an income to the banks. Okay. So a gold book would say, well, this is the ideal scenario to put everything in gold. And Macrotrends started out in 2011. Let's be honest, a bit as a marketing product. You put 80% in gold and 20% in gold stocks. That will be a turbo on your gold. And then in 5 years' time, we will be so rich that we can buy an island in the Mediterranean, something like that. Okay, it went different. I can tell you my first gold I bought in May of 2011. It had been rising for 10 years, and I was like, wow, this is going to go through the roof. Okay, by the end of that year, it was already dropping. The whole 2012, it dropped even further. 2013, it dropped even further. Well, and then I said, maybe I should start re-evaluating my economic theory. So that is very important if you structure your portfolio, that your macroeconomic theory is correct. Because it's really complicated, staying 100% liquid in gold is not safe. I believe in gold, I'm a firm believer in gold, but you have to be cautious. Because To give you an example, the idea that gold would protect us against anything is outdated. Here we have the stock market crash of 1987. The Dow was down by 22%. We would actually be happy today with just a drop of 22%, like let's get it over with and let's get it done, but it will be worse. But gold was up 24.5% that year. So that's where the reflex comes from, you know. Gold is a good hedge against things like this. But as Herr Schmull has said already, correlation is not causality. You cannot trust on correlations from the past for the future, because what happened in 2008, well, the Dow was down by 54%, but gold was down by 25%. And then people say, no, that's not true, because right away it went up. Yeah, but everything went up. So it's not that gold gives you a head start. So you have to be very careful. Gold recovered and went ballistic, but everything else did go ballistic as well. So if you want to have the edge, you have to rethink what gold does for you. So I went to think, how is this possible? Then in 87, you see this clear correlation between the Dow dropping and gold rising. And in 2008, you don't have that anymore. What is the difference? And I have a theory about this. I discussed it with Dimitri Speck last night. He does not agree with me, but that's fine. We're here to, exchange theories. What also happened in that same year was the establishment of the London Bullion Market Association, which is in London, 5 big banks come together and they fix the price on gold in the morning and in the afternoon. And this is over the counter. This is not a free market price. It's just 5 guys on a table and say, well, what's the gold price going to be? Okay? Which is not wrong, because all markets start like that. All markets start over the counter and then they become so liquid that they can become exchange traded. So all the conspiracy stuff around that, no, that's the normal way things go. And then you have the COMEX, which is the futures market in gold, which I believe that during the 90s, there was an intimate relationship between those two parties. And my theory is the following. Futures on gold exist since the 70s. And when they started, gold went up a lot. Why? Because futures trading happens on margin. So you can actually, you don't have, if a future costs $100, you don't have to put $100 in your account. You can put 20 and you can borrow the other 80. So if you really think about that, that is actually debt mastering the gold price. Because if a shock is created, for instance, Cyprus, all of a sudden people saw that there were being haircuts on the banks, and you would have expected that gold would rise. No, gold dropped. And Dimitri will explain this afternoon how that was an explicit manipulation to make sure that people do not connect the gold price to banking crises. Okay? But if you create such a crisis, a shock, well, what happens is that these margin accounts, people get margin calls, because for that $80 that you have lent, you have to have collateral. And if the price of your asset has gone down due to a shock, well, then the broker says, deliver me the cash, because your collateral is short. The value of the collateral is short. So what do you have to do? Well, you have to sell your future. And so the gold price drops even more. And if you accelerate that a bit, the market makers can make that happen. You can create a panic in gold. So my theory, especially if you look at the coincidences in politics, I believe it's my next slide, it's attributed to Franklin D. Roosevelt. In politics, nothing happens by accident. So what do you see? During the 90s, there's 2 phases in gold. During the 90s, here you have the crash on, let me see. Well, it's further away actually. During the 90s, the gold price goes down, and I think that has to do with being short in futures while buying the physical. And then, when that process has ended, you do a one final last push, and that was Gordon Brown, who at the absolute rock bottom of the bear market sold half of the gold of the Bank of England. So I ordered the Bank of England to sell 400 tons. It's 395, but okay. 50% of the gold at the rock bottom. Okay. Then all the friends, between brackets, have their physical gold, and then now we can make it rise. Now it can rise again. So I don't think it's a coincidence that just before the big rise, everything is sold to private parties. Okay. So I explained that. I think the futures market is the place where the manipulation in gold happens. Okay, so that is for me personally the explanation. We can discuss if that is the correct explanation of the fact that your view of gold should change. You cannot consider it as the ultimate. On the long term, yes, but in the short term, you should be careful what you do. So I think that 2011 was simply a bubble in gold. And if you say that to gold bugs, they say, well, that's impossible. A bubble in gold cannot be. You're confusing categories. No, I do believe that a bubble in gold is probable, and we needed 8 years to deflate that bubble. Now we are in the basis, and I waited with a positive call on gold until February this year. Now I believe it's the time for gold. Also, for instance, because Basel III has recategorized gold as an asset that you can count as a zero risk asset. I think that is a very important thing. Gold was not considered as a zero risk asset before. Now it is. So banks can actually, like it used to be, can buy gold to hedge their risk. But stay cautious. Gold no longer gives the protection it used to give in the short run. Okay, so how much gold is safe? That is the big question. I talked to Dimitri yesterday. He said, well, I would go to 25% of my portfolio. Given the history of Macrotrends and given our very risk-averse profile, we go for 40%. Because gold is an insurance against the total failure of the system. That I agree. But a partial failure, for instance, a crisis in the stock market, well, as you have seen, gold has gone down as well. So you must be careful. This is what I call the investment pyramid. Okay? It has a basis of 40% gold. Still a very large position. It's clearly choosing for, limiting counterparty risk. On top of that, 30% cash. On top of that, 20% private equity. And on top of that, 10% public shares. And now we are going to discuss all those layers. So I have an example of, like, let's say you have to manage 200,000 euros. What do you do? So 40%, that is 80,000 euros. Well, if I say 40% of gold, I'm actually referring to 40% of precious metals, because gold is not the only thing. Staying liquid does not only mean that you can change your asset for fiat money right away, but also that you are dispersed in many different things. So if you have 40% of gold, if half is true of what the gold bugs say, half, we will still be rich. So that's why I choose 40%. That leaves also 60% room to do other stuff, to still be mobile, because you can sit in fear with all your gold under your bed and you miss other opportunities which might be nice. So here you have all the precious metals. I believe, Scott, that you also have platinum, palladium, so that are even rhodium would be a good diversification. But of that 40% of precious metals, the biggest chunk should be gold. But I just want to say, don't put all your eggs in one basket. Diversify there as well. But precious metals, and not paper gold. Physical gold. Paper gold is no gold. That is a right to gold. But the whole problem will be that rights will be infringed. Property rights are infringed. In Belgium you pay 56% taxes. How is that respecting property rights? And as Diederik has said, the government can do anything. They can confiscate whatever they want to confiscate. How do you structure that? How do you structure 80,000 Okay, inside out. You take the worst case scenario and then you build concentrical circles around that worst case scenario. What is the worst case scenario? Mad Max, you know, streets like zombie apocalypse. The banks have failed, there's no electricity, food runs out in 2 days. This is the scenario Yannick Verdijk is very prepared for. Where is Yannick? Oh yes, Yannick, if you want to talk to a prepper, he's the prime prepper in Belgium, so he has everything you need for the zombie apocalypse. Okay, if that is the scenario, you must make sure that, let's say, the biggest chunk, again, 40K is what you have in gold at home. So the extreme position would be, if you can't stand in front of it with a gun, it's not yours. But if that is the real definition, well, then nothing is ours, because we cannot even have legal firearms again. I mean, the softer translation would be, the most important thing to limit is our counterparty risk. And that is true, you have to limit it. So, next question. Okay, concentrical circles. The first circle is at home, direct availability. Then maybe the next circle would be, well, I hire a safe deposit box in the bank. No, don't do that. The problem are the banks. And not only the banks, it's also the government who has financial distress laws in order. And I have investigated this for Holland. I don't know if it's in every country, but I presume it is. In Holland, the Netherlands, in 78, they had the financial distress law saying that if the state has trouble financing, they can confiscate anything civilians have. And in 2011, it has been updated. It's not just confiscating everything civilians have, but also what is contained in safe deposit boxes. Well, that should be a red alarm. A red alarm. We don't go to the bank to put things there because you're never sure that you can actually own it. And that is why I actually have chosen Global Gold as the sponsor of this conference. You know that my conferences are never sponsored because I want to be independent. But in the case of Global Gold, I have been convinced of their product for the last 5 years. And I asked Scott, or I said, Scott, if you want, you can sponsor me. So why? Why? Because Global Gold has storage. They're a non-banking solution. They're no bank. They're outside of the EU. Very important, very important. We are going to a European banking union. So even if you would go to your local politician and complain about, you know, how are things going with the banks? No, it's the European Commission that is deciding that, not the European Parliament, because that is totally irrelevant. They cannot even fire the Commission. So why are we voting? I will not vote. So in the bank, no. Do it outside of the European Union and do it outside of a bank in a specialized facility like Global Gold has. A safe in your home would be another idea. No, don't do that. And if you have one, put 5,000 euros in that. Because there are many cases of people who have been robbed by night in their home. You know, you're sleeping, your wife is sleeping next to you, and you wake up and they have a gun to her head. Are you not going to open the safe? Well, maybe if you have a bad marriage, you could say, you know, well, 5,000, wow, that's a good deal. But, you know what I mean, you know, if you love her, a bad idea. So, I talked to my grandmother. She's a big inspiration for me because she comes from a time that was much more sane than our time. She said, you have to hide these things in creative places. And then she looks at me with one eye and said, you know what creative places are? I said, I have no idea. And then she's told me a couple of her creative solutions, which I will not say. You have to use your own imagination. But that's how you do it. Like, if you think about 40K, that's 1 kilo of gold, or that is about, let's say, if I would say that in Krugerrands, I'm very bad at mathematics, but you know, 40 about that. If you divide that in 10 groups of 4, and you hide them away, it's a bit, you know, a bit stupid in a way, but it could be very smart in another way, you know what I mean? So that would be your base at home. Then the circle around that could be a Global Gold, or even friends that you trust, but build it in circles. Okay? So how to structure, huh? So nobody keeps 40% of his assets liquid at home. If you have more than 200,000, it becomes a bigger problem, and I would say that Scott has good solution. Also, very important, when you don't have to go to Scott, but if you choose a program, always make sure it is allocated storage. There are programs, and I will not mention names, who use a concept called gold grams. That is an accounting solution. That is not allocated. That is a good delivery bar of 12.5 kilos. And you own a little part of that, which corresponds to a bookkeeping entry, which, okay, is not on the balance of that company. That's true. But it's too confusing. We have a very theoretical discussion in Austrian economics about the Tantundem, which means that if you deposit coins in a general fund, that the banker has to give you back the equivalent of that fund. But this confuses property rights. Best is to have in a separate storage. There is collective storage if you want it. That's the cheapest solution, but I would not take that solution. I would take the middle solution, which is allocate the storage with your name tag on it. Very important. And then you have the box, the key box. That is the highest solution to really have your key. It's like a safe, but in a box, in a mountain in Switzerland. So that seems safe to me. What to buy? Liquidity. Liquidity. Don't buy, in my opinion, don't buy bars. I don't do that. My favorites are Krugerrands, because it's the internationally most recognized coin. Okay, there have been falsifications, but you can buy this little set and try it out. There has been some Chinese falsifications in that, but if you're smart enough, you can really see it. You know, the shine is different. The Chinese, they're not creative. They just, if you want to fool somebody, you have to be a little bit more subtle. And Napoleon. Napoleon, especially in Europe, are 200 euros. So, for instance, if you have children or grandchildren, teach them how to save. Not in a bank account, but just every coin that they get, give them a Kruger, you know. And if you feel the weight of that, it really has weight. You know, it's real money. But a paper bill, this is real money. You have to teach them from a very early age. Because sound money is sound morals. I sent you the article on Keynes. Have you been able to read it? So that was unsound money and unsound morals, if you know what I mean. Good. Now we have 40% absolutely certain. Okay? Mad Max scenario can come. Even, confiscation can come, but in the 30s in the United States, everybody had to give his gold to the government. Nobody did it. Maybe 3% stupid guys said, oh yeah, I'm going to take dollars for my gold. Most went underground, and gold is something, especially the core of your gold, is for generations, you know. That's your ultimate, it's like a fortress with 3 walls, you know. That's when the socialists attack, you know, if the first wall falls, you go back, you know, and then you fight to the bitter end. So 40%, wow, this is safe. So I feel good. I want to sleep at night. This is safe. And now I have 60% to play. Well, to play, the play happens in the top 10%. I can lose that. That's no problem. Now, cash. You would say, well, are you crazy? 60,000 euros of cash in the banking system? Okay, but we have 80,000 safe. And again, if the gold bucks are right, I can lose all of that. I can lose that 60%, but that 40% will be 200% of what I had. Okay? So, but the cash, how do I structure the cash? Now, you have to be very cynical. And I don't like to be cynical, but we live in a mad system. If you have to put your money with a bank, don't go to a little bank with good intentions. No, you have to give your money to the mafia. You go to the most corrupt bank you can think of. Why? Why is that? Think.
To be part of the same guys.
Yes, yes. The government, Murray Rothbard said, the state is the mafia writ large. De staat is de mafia in hoofdletters. So the same guys who were in the banking system are now in politics. And ex-politicians go to the banking system. So these are old boys networks. Do you really think that a bank like, I will not mention names, will ever go broke? No, they will bail them out. It's the small, honest banks that will go down. I'm very sorry. I don't feel really good about that, but I don't have to save the world. I have to save my world. And then, if everything has gone wrong, we take our seed and we sow again. You know, it's a very philosophical thing. You have people who are trying to be better than the best person. Don't do that. Be smart, you know. Save your own world, not the world. Okay? What currencies? Well, you don't keep it. We are in the Eurozone, but don't keep them in euros. If you have listened to Diederik, you should have dollars. If you come home, buy dollars right away. I think he's right. I think the dollar will appreciate. He says 30%. Even if the dollar appreciates 15%, I will still be very happy. Because the buying power of the euro is clearly going to go lower. If you just look at the inflation that we had, the real inflation, not the measured inflation, in the Eurozone, how expensive everything has become. Your best hedge is the dollar. Because if the euro crashes, okay, gold will go up in euro, but what will that mean? You know, you need an international currency. If you have to flee to, maybe not to Russia, because their dollars might be a problem, but US dollar is still the international standard. And the other half, so 60,000, put half of that in euros, leave that in euros, and the other half in USD, especially USD, but my other favorites are the Swiss franc and the Norwegian krone. Swiss, why? Well, pretty evident, I would say. And the Norwegian krone, because there's oil behind that. You know, if the Norwegians run into trouble, you know, they pump up more oil, and that's the end of the story. Also, it's a very small currency, and if a lot of people think like I do, if a small currency has to receive a lot of capital, it might just surge like that, okay? The Norwegian central bank might say, whoa, we are getting too high, we are going to inflate. Okay, but inflation would have been a problem anyway, so you have to be careful. The NOK thing is a bit of a speculation mine. If you don't want to speculate, put half in euros, put half in the US dollar. Also, the euro and the dollar, you have two kinds of money. You have bookkeeping entries in the bank, and then you have the bills. I say to my subscribers, of course you will not have $100 bills like Dagobert Duck at home. You have to have some, most you leave in the bank, but also make sure that you have like $5,000 at home in bills. Make sure you have 5,000 euros in bills. You know, if you look at what happened in Greece, people could take 60 euros out of the bank on a daily basis, waiting for 5 hours in line. You know, you don't want to have that. Be prepared, you know. Have that at home. And then part of that 30%, also, how much of you are in cryptocurrencies? Put up your hand. Well, I would say about half, okay. The other half is pretty predictable, will be very conservative gold owners who say, well, that's just air. Well, maybe, but while it's air, it has gone up 300%, or 300 times. So I have to say this, Macrotrends has been the magazine in the lowlands who discovered this trend very early. We did it with Bitcoin. We bought Bitcoin at $60 and we maxed out at $15,000. And we did it again. We bought Monero, XMR, at 60 cents after we have been investigating it for 2 years. And then we said, buy it now at 60 cents. You see where we bought. And we maxed out at 300 euros. So now I have subscribers wanting a 10-year subscription and say, well, sorry, we only do 3 years. But I would certainly advise to do that. And we are now investigating a new cryptocurrency. And I know there's new cryptocurrencies every day, but we look for the technological innovations. I will not say the name. That is the 22nd of September. We will have a whole afternoon talking about that. And we think we can do that again. So stay tuned. This is also very liquid. So it's not a lucky shot. Here you see the, oh, we actually bought at $5. I thought we bought at 60. Yeah, it's not a lucky shot. We have a specialist in the house who really, he's a bit of a freak. He studies this every day. I'm also a freak, so we were friends. So okay, so that is the liquidity part. So okay, it's fearful to have 60,000, but if you diversify it with 2 or 3 corrupt banks, if you diversify it between euros and dollars, if you diversify it between keeping it at the bank and keeping it at home, you have 6 compartments where you can diversify. Okay, so if one thing falls out, you still have 5 parts. That's how you have to think. Okay, now private equity. Why do I like private equity? Because public equity is very liquid. And you would say, well, that's a contradiction because your strategy is a liquidity strategy. Well, yes and no. The advantage of an exchange-traded stock is that you can sell it at any time. But if a crisis hits, that's a bad thing. You know, if everybody starts selling, we saw it in Apple. That's why the Swiss National Bank went down, because their biggest position in their portfolio is Apple. So they print money and then they go buy Apple. You know how foobar things are right now. Public equity is very prone to shocks. That is a problem. Private equity, they are traded over the counter, if they are traded at all. Most private equity investments do not allow trading. You buy it and then you wait for the dividend, or you can sell it back at a higher rate, but there's no internal trading. And I like that, because if there's no internal trading, well, there's not even the chance to manipulate the prices. So I started, okay, and I want to say, private equity sounds very exclusive nowadays. If you go to a reception and say, well, I'm in private equity, it's like, wow, you're like the guy, you know, with all the buzzwords, you know. But it's actually the original form of investing, you know. You have a great idea about this bakery shop you want to start. Well, 3 friends put together money, and then you take a share of the profits. And that is the etymology of shares. And we tend to forget that a share is about a share of the profits. Nowadays, stocks are traded for the plus value on the stock, not for the dividends. And the government doesn't help, because they tax dividends so much that you have to speculate in the market. And then afterwards they say, well, look, the problem is speculation. No, the problem is taxes. People are trying to make a living and you are taxing the hell out of them. Okay, so we have lost the connection. Shares are traded for the plus value. PE is back to the origins. So, if you go into that sphere, you encounter so much bullshit, really. I'm an angel investor. What? An angel? What is that? We have an incubator. Well, startups. Everybody's talking about startups nowadays. I don't care. I want to invest in something that I understand, and I have 3 criteria, the 3 M's. It has to be a macro trend. That's the name of our business. It has to be, we have to have good management. This is highly undervalued nowadays. It's like management, you can go to a management school and then you're a manager. No. You cannot learn management. You cannot learn it. You're either a good manager or you're not. You can enhance your natural possibilities, but I don't believe that having an MBA will make you a better manager. And then I want to see multiples. You know, if I'm so high up the risk ladder, well, if I put my money in there, it has to be a good investment. I don't care if gold doesn't give me a percentage. It's for my safety. But as I get up the pyramid, I want to see more multiples. I have 5 minutes, perfect. So what I do extreme due diligence. So if I go into a private equity opportunity, anywhere between 6, half a year, my latest thing was 15 months before I am sure that I want to do it. Because I want to map out all the risks, all the contingencies, and they have to answer how are you going to mitigate that risk, okay? And as a consequence, I only give one opportunity a year. Last year, we invested in BioAegis Therapeutics, which is a very interesting company. It reproduces a natural protein that we have in our bodies that can help against infection. So the biggest problem nowadays is that bacteria get resistant to antibiotics. Well, this company, I truly believe, after studying the sector, that they have the solution. They're at the end of phase 2 clinical testing, and I will believe we can make between 25 and 50 on the multiples in 5 years. So that's not a big investment in my terms, but it can give a lot of revenue in the long term. And my pet project for this year is totally different, but if the economics are good, I don't care what I'm investing in. There's a movie you will see in the next 2 years. So the winter of 1920, the winter of the year next year in the winter. It's a psychological war drama. And you would say, well, how is that a macro trend? Well, the macro trend there is that you have to analyze Hollywood. Hollywood used to be big studio productions. You know, you had to have budgets of 100 million, 200 million, and those still exist. But what you see now, due to new technologies and new ways of thinking, is that on a shoestring budget, you can make great movies. This movie has a budget of 6 million, and it has been projected that it will deliver 24 millions in gains. So for me, that's good. That's not a multiple of 25 to 50, but I'm okay with that. So this is the second one. And next year, and I'm working on that right now, is another macro trend. The European population is aging. And what you see now is the phenomenon of the stove, the old stove that used carbon. They now use pellets. Okay, there's a huge demand for that. My grandmother bought one, and then my parents bought one. I said, guys, you're 60, why? You can still do it, you know? No, we want to have one because we are thinking ahead. So the demand for pellets is enormous, and I am investigating that sector because there's a lot of consolidation going on. And I have found a company in Poland that is worth my attention, but let them suffer for another year, you know, prove what you can do, and then next year I might come with my team to see if we can pick up some equity there. Okay, so that safe, okay, you do understand that safe is relative. The most safe is below, then a little less safe, and now the most unsafe thing is public stocks. Be very careful, be very careful. I mentioned Swiss National Bank. I have 3 more slides and then we can go to questions. They are printing money and then they are buying Apple shares. So, you know, the buybacks of shares, for instance. Companies loan money, they buy back their own shares, and of course, if there are less shares for the same value, the value per share goes up. But it's a mirage. It's just smoke and mirrors. I do not believe any of the valuations in the public equity market. So why am I still investing in it? Well, because there are companies who are really doing great stuff, and I found 2 companies, but about those companies I will not talk. You have to understand I have to leave some of the exclusivity for my subscribers, but to give you an idea, on the first company we gave a buy signal at 20 cents in 2014, so we are long-term investors. Now it stands at 62 cents, but I believe that it will stand at $2 by the end of this year. And since this presentation is well, there will be a video about it. I cannot say it publicly, but if you approach me in the coffee session, I might say what it is, if you are very friendly to me. And the other one is a company at 72 cents, also in 2014. It now stands at $1.11. But this one, I believe, in a couple of years, we could be at $8. This has so much potential. It's such a big macro trend that I truly believe that we can make a lot of money. And so, what actually happens, so now we have the pyramid, if things work out, your investing pyramid becomes a value volcano, you know? On top you take risks, but the multiples are so high that you then consolidate your profits below. So what happens is that your pyramid grows, and in the end, everything is pink. Life is beautiful. Thank you. We have 15 minutes for questions. I was a bit over time. Good. First question.
You said 30% cash.
Yes.
Is government bonds globally, is it the same as cash?
A fiat dollar bill is a bond with a maturity of 0. So technically you're right. But, well, and this is my big discussion with Diederik. He believes that if you go in 30-year treasuries, because when a recession comes, capital flees to the wrong run, which makes interest rates go down, and so the plus value on your treasury rises. Okay. I do not feel comfortable with that. I believe in liquid dollars, really liquid dollars in your account. But I understand if you're a fund manager, that's not done. But I would not call that cash. Even repurchase agreements between banks are cash. So the definition of what is money is very subjectivist. But for retail investors, I would not do that. Yeah, you could.
But when you have 30% on 1 million, let's say that, so 300,000 cash to invest. I understand 5,000 liquid dollars at home or 5,000 euros. But when you invest all the other things at bank accounts in dollars, in euros, euro is not even 0%, and the German government bond is also 0%, 10 years.
I know, if you have bigger...
When you look at the pyramid, you would say that the government bond is safer than the...
It always used to be safe. Why? Because there was still enough to rob. If you have taxes at 20%, there's 80% still to rob. You don't rob from the rich because there are not a lot of them. You rob from the poor, there are a lot of them, and they don't have any resistance. But that is gradually running out of steam because the problem is that you have squeezed the lemon so much already that I truly... Like if you look at government deficits, how are they being financed? Through lending more money. So as Diederik has said, it's a cultural thing. That's why in Macrotrends I have enormous attention for psychological manipulation. All the terrorist attacks we see, I do not believe anything about that. I believe they are organized to keep people, if you say that, whoa, you're a conspiracy theorist. Well, politics is one big conspiracy against freedom. So that's not so strange. But the thing is, it's about confidence. And if confidence drops, that's why elections are so important. Not because people, why do they want us to participate in elections? To maintain the illusion that we have an influence. Not because they're interested in who is going to govern, because before the elections they already made agreements. And using the press, you can direct the populace in whatever direction. So it's about confidence. And I do believe that Diederik is right that despite the declining confidence morally then in the United States, because in the United States when I was young, that was the land of inspiration, freedom and liberty and whatever. And I think since the Iraq war and then Afghanistan, perception changed. But perception may change for 30 years. So it can be that this empire, because it is an empire, can last another 100 years. So the key word is confidence. If you are confident that the United States will be able to pay its debt in whatever way they find possible by US treasuries, because I do think that they will go down the interest rate on them will go down, and so the plus value will go up. If you have $1 million, we are retail investors. I don't have $1 million, so I don't have that much problems. But if you have more than $1 million, then the real deal starts to structure your portfolio. But if you feel comfortable with government bonds, do it. I wouldn't do it.
They are the lender of last resort. They have to save the other banks.
Until they can't.
What is higher in the pyramid than...
Yeah, until they can't, I think it's a deal about the population. If you look at the populism in Europe, they call it populism. I call it truth movements. If you like yesterday, the yellow jackets in France, they attacked the Masonic temple. Well, they at least are awake. They know where it's coming from. Alternative for Deutschland, True Finns, Vox in Italy, the Brexit. Only in Belgium we are so stupid that we don't do anything, But the people are waking up, and add another 2 years of crisis, deflationary crisis to that, and it might be that just, I think it will start in Europe.
I agree on that.
And then maybe if it starts in Europe, then government bonds, 30-year government bonds, long term, could be a good idea. But I also have moral issues with that. I cannot help it. I call it a tracker on slave trade, fiscal slavery. It's just a tracker on fiscal slavery. I don't want to buy that. Okay, next question.
So about 15 years ago, I had this strategy.
Wait for the mic, please.
So about 15 years ago, I was advocating the exact same strategy, saying stay liquid because property is overvalued. It's going to crash. When it crashes, I will come out of liquidity and buy this property. Of course, when property was about to crash, they reduced the interest. Government reduced the interest rate, started printing money, and reflated the market because effectively, when you're saying when everybody else is going to get poorer but will be richer, the government wants to buy votes. So won't they do this again? And isn't there a risk that they will, we stay liquid because you're right, but when you're proven right, the government will step in and make sure you're wrong. So that's the first question. The second question is, what do you think of peer-secured, very well collateralized, short-term peer-to-peer lending?
Okay, first question. Again, I think everything has to do with confidence. It's true that, like 2008, they shored up everything. And I said, this is going to last 2 or 3 years and we will see the same. No, it lasted 10 years and I was wrong. Okay? But in that 10 years, if you analyze how public opinion has, changed against the state. I was a libertarian 10 years ago, and if I said, we live in a fiscal slave plantation, they were taking their beer like, this is a strange guy. And if I say, no, why do you say that? They're at least interested. Make that another 10 years, and I think Austrian economics, for instance, will be the most popular way of analyzing the truth. And that is why you need so much entertainment, and so much diversion, and football, and quizzes. And I'm saying you're staring at, like when you go shoot bunnies, you have this light, and then they all stare at the light, and meanwhile they are being robbed. But this is changing. I feel it changing. So you're right, you were right, but the marginal utility of manipulation drops. If I fool you the first time, I may fool you a second time, but the third time will be harder. And I do believe that we are reaching the end of this paradigm. Your second question, I'm not specialized in peer-to-peer lending. Well collateralized, it's all about how you value risk. And I have to know the people I'm investing in. I don't know if it's across a platform with people you don't know. If you have a cousin wanting to start a bakery, put your money there. I also have a problem with all that transactional investment. No, look in your street what needs or what is an opportunity and invest close to home. That's what I do. The director of the movie is today our cameraman. So he will make a big Hollywood movie production, but I know him. So I know how he is. I know he doesn't drink a lot. I know he maintains his deadlines. So if you talk about risk analysis, and you don't want to go into an online platform which looks shiny, but you don't know the person. I would never put my money there, I'm sorry. It's a nice concept, but I believe in the classical stuff. Okay, maybe Mark over there. And also, yeah, let's see, we have 10 more minutes.
Yeah, Brecht, you talk about private equity. Could you replace that with revenue-producing properties?
Well, that's real estate then.
Real estate? Yeah.
The thing about real estate is that it has been exploding in price due to low interest rates, because a house for most people is a capital good. And so the reason prices have gone up so much is because banks used to give loans like that. So
Yeah, well, if it's paid for and it's producing revenue.
Oh, you don't have debt on that. Okay.
It's not your private home. It's owning real estate that produces income.
Okay. If it's paid, if it's not financed through debt, yeah. I would say yes.
If you can, would be a good replacement for the private equity.
This would be private equity, but be careful, because you have to know, it's a very individual question. If your plan is not to sell this house or this business for the next 30 years, this is my thing, no problem. If you are worried about it dropping in price 50%, then you shouldn't have it. It's hard to answer such a question because it's very individual to what your objectives are for the future. But if you have something like that and there's no debt behind that, well, that's a cash machine. Although I have to say, that, you know, I've advised clients and I asked, you know, what is the return on real estate nowadays? Oh, 3 to 4%. I said, what? 3 to 4% in a market that has an inflation of at least 5 to 6% real inflation? So maybe you should reconsider that also. I believe in liquidity, and true private equity to me is more projects that last 3 to 5 years, where you put your money in, you get it out, you go to another thing.
Yeah, well, in Holland there is a huge demand for places to live. You know, people don't have places to live, so you can rent real estate. It's good.
Yeah, if you're not worried about the plus value or the minus value on the asset, that's okay.
Thank you.
That's my question. Now I would like to hear Mark, what he has to say, and then we'll go to this room. Very sorry, yeah. Amado, you're the next one. I'm very afraid now because Mark Valek writes a report every year, about 1,000 pages, so I'm sweating and trembling.
Relax, Brecht. Thanks for the question. I just wanted to ask, did I miss, where did you put the cryptocurrencies in your inverted pyramid? I would guess it's up there on the top.
No, I put it in the cash section.
Cash?
Yes, because, well, yeah, good question. Is it cash? Is it money? Well, you will talk about this afternoon. It's not actually. So it doesn't really belong there, but as it is highly liquid and as it has the intention or the ambition to become money, I have put it in there. Yeah. But you cannot put, I would put like 2 or 3% in crypto. I would not put more in crypto than that because it's highly volatile. Actually, it's a valid critique. It's not, you cannot consider it cash. You have to consider it as a, well, is it publicly traded? Yes, you could consider it in the top 10%. Maybe I should put it there.
Okay, I just wanted to know.
Yeah.
Thanks.
Yeah. Amado.
Thank you, Brecht. Very, very interesting. Why do you consider public equity to be riskier than private equity? That will be one. And secondly, what is the diversification that you recommend for both? Like 4 or 5 companies? A bit more than that?
First question, why do I consider it more risky? Because of the liquidity, ironically. So if we have a shock and you enter into a panic, the risk of losing your capital is a lot larger there than in private equity, because private equity does not have a price on the equity. You have implicit valuations. For instance, like BioAegis was a company that's valued at 60 million. Now, if we end a trial phase 2, it will be worth double. But you know, there's no trade in that, so I don't really care. What I do care about is that in the long term, I get my multiples from that. But it's right, it's true that, for instance, vetting the due diligence before a stock can enter in the venture exchange, well, they have to go to the Securities Commission and they have to file all kinds of reports. And in the private sphere, that doesn't happen. You know, there are some rules about having to make a prospectus, but you know, there's so much things you can, you know, I don't trust paper, never. You know, like you can have 2 bookkeepers evaluating the same company, and the one bookkeeper will make it a big, wonderful company, and the other one say, wow, this is a problematic. It's so subjective, you have to know the people. I trust people, I don't trust paper.
That's probably why you put the image of the Swiss National Bank. Like they put so much money into Apple. They didn't in private equity. What I'm trying to say is that sort of public equity is where the money goes, where there's a quantitative easing, where it's private equity not so much. So those swings in the market can affect more.
Brutal, yeah, more brutal. Although I think in the private sphere, what you do see is an enormous wave of mergers and acquisitions. The number of M&A in the last 10 years is enormous. Why? Because credit is so cheap. A management buyout, you put 10% of equity on the table and 90% is a loan, because the theory is that the company that you are taking over is so profitable that it will repay the debt. So in a low interest environment, you get a lot of money that goes everywhere, also in private equity, but not always to the best projects. And that's why I do extreme due diligence. Maybe. 1 second, are there other questions on that side? Because I have been treating this side very well, the other side less. Okay. Here you had a question?
Yeah, what would be your...
Wait a second, please. And then we have to go to the...
what would be your advice to young entrepreneurs wanting to build a capital? Because right now, capital is cheap, as you said, so it would be an ideal environment to do M&As. Or what's your view upon it?
If you're young, you don't do M&As. If you're young, you construct capital. First rule is you spend less than you are earning. It looks like simple, but it's not, because there are a lot of startups. They work with borrowed money. They already drive a fancy car. They fly all over the world to sell their product, which is not even a product. Be humble, save money, and also be smart when it comes to your jurisdiction. I was in Belgium. I had my own company until I saw how much, how big my fiscal slavery was. And then I took the map of Europe and I said, what is the cheapest country in Europe for tax-wise? And I moved there. That's one thing I would do as a young entrepreneur. Don't stay where you are. Don't stay in Belgium. It's very hard. I would like to stay. They are talking about refugees. Well, I am a refugee. I'm not kidding. I'm not kidding. Well, how nice would it be to have my company in my own country where my family is, where my friends are? But most of my friends who are here today are refugees. They have to go to other countries to have opportunities. And, we live in diaspora, as far as I am concerned. So when this whole thing, shabam, ends, I would like to go back. That would be one thing I would do. Before you even think about a product, think about your jurisdiction where you are located. I think that's very important.
Okay, got it. But I had your paper in mind, or one of your writings, in which you say that you have to compete with the big money. For example, the writing that you put out was about supermarkets. Like all the local shops are driven out, or I don't know how to say it, but because they have to compete with all the big local supermarkets, which are financed by all the big credit companies, all the groups, and all that kind of stuff. So,
to be really,
it's in a hard environment. So
it's very hard.
Should we join the big boys? Or?
Yes. I think you have to be pragmatic. There's this Dire Straits song about, I don't know how he's called. He has a daytime job. He's doing all right. Do you know what I mean? The Sultans of Swing. I think it's bad music, but anyway, it always comes to mind. Don't be arrogant. If you're young and you don't have capital, you must be happy with a job. But the job is 7 hours, 36 minutes, according to the unions. And then you have 16 hours left. Well, sleep a little less, and use that other 8 hours to be creative on the side. And then when your business picks up, and it's true, it's very hard to find a niche nowadays. But the other thing is, when you have big companies, you have very bad service. So even if you work, I will not name names, but if you work in a big electronics company, and you notice that there's a niche in the market that is not served, why would you not combine those two things? So that's the way to go, to be humble, to, when the elephants are fighting, the mouses have to crawl away, and until you are a hyena, and then you become a lion, and then one day you're a big fat elephant in your living room. But I would go that way. Okay, good. I think, is there any last question, maybe? No? Everything is clear? Okay, last question, and then we are going for lunch.
What do you think about buying the Swiss franc?
No, lunch, no, we're going for Scott, sorry. The Swiss franc, well, I told you, I think that's a good... You have to look better. It was one of my favorites. You have the American dollar, then the Swiss franc, and then Norwegian crown. That are my three favorites. But the biggest chunk in US dollar.
And to buy it, where? Traders only, or?
Well, I just spoke to a gentleman here. I am investigating on how to open an account in a Swiss cantonal bank. I think that would be the safest option. But it's not easy.
In combination with gold to store your money there?
No, they store gold.
Yeah, but also you have to have some money also you can buy, and you can sell gold. And then you store it in Swiss franc, maybe.
Well, you have to talk to Scott. I'm not sure. Okay. If there's no further questions, I will give the floor to Scott, and then we will go for lunch.